Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It's Friday, the day after. I have never seen anything even remotely close. I mean, maybe in other markets, like the ES has certainly been, the equity indexes have definitely been wilder than yesterday, but the treasuries, holy crap, I've never seen anything even close to that. It was wild. Let's look at the charts here. CPI pushed us down. I flipped out, kept going lower. I made my money back. I don't know how I did that. I'll talk about that later. Anyways, now somewhere over here, who was it? Bostic? That's Bostic came out and was like, I'm very concerned by these numbers. Maybe we'll have to do a 50 basis point increase. Maybe we'll even do an emergency meeting sort of a thing. And we went lower. Kind of snapped back on that one. The market, like, really, like, the micros, all the liquidity in the micros was completely gone. I had to go in. Remember when we were doing that thing a few streams ago where, you know, if I come back over here, where I had to like move to put a bid in and like slowly move it up, and, or, you know, because nobody could put a bid in at the correct price. Like, I had to do that again in the 5-year and fix it. I wasn't in a position, but I fixed it. So if anybody took a trade late on Friday in the 5-year, you're welcome. Okay. So that was nutso. Okay. And then some selling into the close. Now, in the overnight session, in the European session, we've kind of come back. Now, the situation is not so dire in Europe. That's why, again, a lot of people are buying European assets to get back up there. Now, there was, yes. Now, I saw rumors about an emergency rate hike. You're correct. So I forget who it was. Some analyst was saying they might do an emergency rate hike Friday morning, Monday morning. Zero Hedge was reporting that. But on Bloomberg late last night, there was a story citing Fed sources that pushed back on all of this. And I really mean, like, they pushed back on all of this. They were saying, no, we're not going to do an overnight hike anytime soon. They were even pushing back against the idea of a 50 basis point hike. I think that at the moment that there is going to be disagreement on the board, like for the board to do something, they're going to have consensus, and they probably don't have consensus right now. Bostic, he looks like he's leaning towards, yes, 50 basis point hike. But, you know, the doves and the newer people that are on there, I don't think that will be the same. So I do not believe that there will be an emergency hike. Well, they didn't do it this morning. They would have done it at 6. Okay. They would have done it at 8 o'clock Eastern time. So it's not going to happen today. I don't think it's going to happen Monday. Okay. So good catch, but it looks like they've pushed back on that for now. Okay. Now, the S&P 500 was fine until Bostic came out and said, yeah, maybe we'll do the 50 basis point hike. And then they just completely fell out. I was really shocked that they held like the previous day's lows and all of that. These prices seem much more reasonable. Can we move down to like the FOMC prices? I think that those are within the cards. I don't think that this has to be like the end of the world for equities. But it's starting to get concerning. Like, I'm going from there's no way we're gonna have a recession, this will all be fine, to, well, we have to start putting those scenarios on the table and start considering and planning for them. I'm not saying that it's gonna happen, but I'm saying it's on the table now. Okay. Oil got hit pretty hard when the equity indexes came down, but overnight they have pushed back. So this is a really difficult, choppy trade in oil now, because you've got this dichotomy between the economy, people being concerned about the economy, but meanwhile, OPEC is just not producing enough oil. So I think that the $100 oil scenario is still likely, but it's probably going to be very difficult and choppy as it gets there. Okay, natural gas still kind of petering off. Now gold, I don't even know what gold is trying to do here, man. Like this looks to me like the traders in gold, they don't really know what this means. It's like it's inflation, but it's higher rates. We don't know what to do. It's basically unchanged from the news, but like, good grief, this is just a mess. Copper took a hit, as you'd expect. And then the other one was, and now Bitcoin, this is the most interesting one, I think, is Bitcoin, they started to rise off of the news initially, right? Well, okay, so they fell, they came back. It mostly followed the S&P 500. Like Bitcoin is just following the S&P. So this asset just does not act the way that people say it should. It just doesn't. It's a risk asset. All right. And the dollar initially, well, they spiked, they went lower. This is just this whole mess. It's just like, it's so weird. But for now, the dollar has been higher on flight to safety risk, which is kind of funny, right? It's like, oh, geez, we're getting inflation. It's a big problem. Oh, I know what we need to do. We need to buy the dollar because it will save us from the inflation. I don't know. It doesn't make any sense. Yeah, well, but probably we're going to see a lot of, during this period, confusing moves. Okay, CPI scam. Well, okay, so there's a couple of things that we should think about here, that we could talk about if we really wanted to get into the numbers. And to be honest with you, I am probably not the most qualified person to speak about this. I think that we need to learn a little bit more. I need to talk to an economist. Apparently there are weightings in the CPIs that they use based on user consumption, and that those change like every 2 years or something like that. And they changed this past month. So a lot of people were saying that they're going to like rig the numbers, but then it still came out hot. Yeah. So I don't know. Another thing is there's the core versus the regular CPI. And on that note, there is energy-based inflation out there. But the thing that really concerns me the most, and I highlighted this on the TikTok, and I think I put it here on YouTube Shorts too. Well, I'm replying to somebody on TikTok. I just leave it on TikTok. But food inflation is really high. Guess what? The United States gets 80% of its food supply from the United States. It's domestic. So a lot of when I look at food, I think that is the thing that really kind of is like the litmus test behind a lot of the theories that people have out there, because people are trying to say this is entirely supply chain driven, and I say no. I say no. Of course, the ports are backed up, okay, but the things that are just here in the United States are going up. Well, we're having this argument. Somebody, I'm having an argument with somebody on TikTok right now, like making a bunch of videos about it. That they're like, the reason that we're seeing inflation, they think, is because companies are just being greedy. Like they're having record profits and they're raising prices. How can that be? Well, tell me, have you ever seen a situation? You buy a product, you're like early, right? Okay. It becomes really popular. The company is doing really, really well. And then the company slashes prices. Does that ever happen? It's not. I haven't seen it in my lifetime. Here's the thing. If you're doing well, that kind of suggests that you could raise your prices and you would still get a lot of people to buy it. That's what that means to me. Right? So I don't know. of course, there's a lot of different reasons that they're raising prices, but like the big key, I think, is that they can. See, before all this mess, before COVID, it was always like we were seeing inflation. Like remember when we had the trade war with China, for instance, you would see the producer inflation increase, but the consumer inflation stay the same or even drop because the manufacturers couldn't pass the increased input costs onto the consumer because the consumer just couldn't afford it. They wouldn't buy it if they did it. And so they didn't raise the prices. Why are they all of a sudden raising the prices now? Because people have more money, guys. And you look at every metric, every effing little metric, personal income, the retail sales numbers, the imports, everything is up post pandemic because we overstimulated the economy, right? So, and again, I think that food is the best case to say it here is because like it's all domestically created. Why is that still going up? People can afford it. Okay, so that's the situation that we're in now. Here for today, it gets a little tough. I haven't even kind of gone into like what our plan is. We have consumer sentiment at 10 o'clock Eastern time, so that's probably the big driver today, right? But they also need to realize that what we saw yesterday was like a true washout. Like the market makers got destroyed. Anybody that had been long trying to buy this thing on like inflation, peak inflation, which was kind of where I was at, they're all busted, right? So that really sets up an opportunity for mean reversion, but there's also extremely high risk of further downside and more headlines today. And then we've got that piece of news that might kind of keep things constrained because again, people might wait for the news. So, and then on top of that, it's Friday and I suck at Fridays. So I think that my plan is to just relax a little bit. I think I was getting a little too stressed. Now for me, so here's the thing for me. I was coming in, I was like, I'm really sure about this one and I want to take the bet and this is going to go. And if I have another like big loss day, then I don't know if I can justify continuing to do this. Like I was saying that like going into it. And so when I took the big loss, I was really upset. Right. I'm getting like I think they call it rejection sensitivity. I don't really get that with people anymore because I stopped caring. I guess that's like I have my secure relationship. I don't really give about anybody else now. But like when the instrument that I'm trading starts rejecting me, I immediately I think it immediately affects me. Like I'm just too neurotic, right? So I think so. Number one, I do think that we need to spend more time working on other stuff and not trading. So I think that will probably mean that most Mondays we won't have the stream, and it might also mean that some days like today, we can work on some other things. Like we can. I don't know. I don't want to work on my indicators. I don't want to because I'm not going to show the source code for that. But like, if you guys want to talk about programming things, like Fridays would be a really good time to do that, right? So we do want to spend more time doing other stuff, but generally speaking, for me, that probably the biggest thing that I need to do is I've got to figure out a way to keep myself in it when I'm losing, right? We've got to find ways to get that dopamine and that norepinephrine so that we can keep going and still make wise decisions. And we need to understand this market better because, I really thought that after we had, I was thinking The market is not pricing in the chances of interest rates rising very well. And then after, that initial move in January, I kind of thought that they were done. And that they had gone too far, so I was taking the mean revision trade. But I think that I have miscalculated like the effect that trend is having on all of these other players, because I was trying to go short rates way too often, way too often. So that might be a place where we can do some research. But don't worry, I'm not going to stop streaming. But the channel will have to evolve as we evolve, right? And we figure out what the audience wants and needs, which is a super hard thing. I got to tell you, like, one of the things that's so hard and frustrating for me is like, okay, I can form theories about what I think the audience wants and needs, and I can make content about those things and then see how they do. Well, one thing is maybe my implementation of it might not be very good, and so maybe that video doesn't do very well because of that, right? But then the bigger problem is that if a video does well or doesn't do well, not if a video does well. If a video does well on TikTok, it's usually I did something right. So like every time that something blows up, I'm like, oh, okay, I got to zero in on that thing, right? But there has been instances where it's like I did something really, really good, and everybody's like, oh, more, and then you start doing more of that thing, and TikTok doesn't send the viewers your way. It's like they lost interest in it or something. So I don't know what to do about that, but that's the world we live in. But when I'm losing, I need to learn to not be so whiny about it. I need to find a way to make it entertaining for you. Would it be more entertaining for you if I just got totally pissed off and started throwing things around the room and stuff? I don't know. Well, man, that 10-year came back real quick there, didn't they? I don't. You know what? I don't know. I don't really want to touch this today now. Well, if we wanted to be buyers, this wouldn't be a bad spot. I don't know. I could see myself. I don't know. This trade, once I start listing out the risk reward and everything, I don't think that this trade makes much sense, right? I could go short at 20.015. No, let's just say that I got it. They already ticked down once, but let's just say that I got it, and I could try and get 2. Right, but like, what's the upside on this thing? Is a little silly. I don't know if that trade really. I don't know if the risk reward on this really makes sense, even though there's maybe a good probability that they do touch 2% today. You need to boast some Ferraris and Lamborghinis. I do. Here's what needs to happen is I need to become a Garlic Coin millionaire, multi-millionaire. Look, they've been doing really well, by the way. Have you looked at? Let's see where they're at this morning. The uptrend in Garlic Coin is like, oh my gosh, Seth, you're gonna be a millionaire. That's why when I come and I look at it, it starts to make me a little nervous. I'm like, they need to get listed on Coinbase so that I can sell when I become a millionaire, right? Look at this. Oh man, they're almost up to 12 now. So like if you come back to like a 3-month chart, look at that freaking trend. This might come back. Yeah, sure. This might come back. But like, good grief. Of course, technicals don't predict anything, but they've never had an uptrend this consistent. So yeah, maybe I don't know. I won't waste money on a Ferrari though. I don't. I feel like it's such a waste of money. I think your whining and momentary disappointment in questioning yourself is more relatable, not entertaining, but it's shit more / viewers have experienced than will admit to. I know, right? It is. It really is. But maybe I'm wrong like, well, here's the thing is a lot of people have told me, at least really early on in the stream, I remember a lot of people saying like, how do you remain so calm? Right. And I don't really feel like I do. I feel like that when things go poorly, I might be calm on the outside, and I might not be like experiencing a ton of turmoil on the inside. Like if I get losers and I'm going like beyond my risk limits, then I really start to be like, oh my gosh, like it's so, oh it's such a, when something bad, really bad happens and there's nothing you can do about it, and you wish that you could like change reality, and it's so like, I hate that feeling, and I'll get that feeling. But lately it's like I'll take a trade and it doesn't work, and I'm just like, I feel like that my decision making just gets worse, right? Like if I do well, I should probably keep pushing it. What I often do is I'll do well and then I'm so afraid of like screwing up again that I just go, okay, $10 is good for today and end it, right? So I end up with loser days that are way bigger than my winner days. I should push it. Like a day like yesterday, I think what would have happened if I had taken the trade the right way, I would have made like $80 and I've been like, okay, that's fine. But if I kept trading it, probably could have made like $200, right? So that's, I got to change that. I got to change that. I think I'm more neurotic than the average person. Part of it is an ADHD trait, but I also think part of it may just be genetic. Just that's my personality. I'm slightly more neurotic than your average person. It's not like the teeniest tiny. It takes a little bit to push me over the edge, right? But in this situation, it's like a week or two of like pent up frustration coming out, right? Well, this is like saying the thing is that when I get the loser, my decision making seems to get worse, don't you think? So we've got to figure out how to keep myself back on track and how to keep myself motivated. Like I was also thinking about that and going, well, I've had some problems. Like I don't necessarily do all of the work in the evening that I would like reading and so forth. I spent a while where I was able to read like I read Dune. That was a read. That was like a week or two of regularly reading. I'm not usually do that. Then I started reading some other books, but I only kind of like started them and didn't get very far. And then like I'll get in the evening and I feel like I'm too tired and I don't want to do anything and I want to watch TikTok. I think that it's not just that I'm tired. I'm thinking it's not just that I'm tired. It's that I'm running out of the motivation chemicals, and I need to find healthy sources of dopamine and norepinephrine to get me to focus and do the things that I actually want to do, right? So I'm seeing that in the evening, or like another one is like I'll go to work out and then I don't feel like it's like really it's cold, it's hard to get myself to work out, and then when I do work out, I feel like I just tire out so quickly, or like I just always kind of have like a headache and like feel dizzy-ish around. That might be medication wearing off, but the workout has not been going as well this winter as it has in the past. It's just so bad. It's so bad. But then I realized like, oh, you know what? If I get in there and I turn the radio on, then I do a lot better. Right. So music is a pretty healthy source of the dopamine, I think. So that's like one thing. What we do about that on the stream? I was thinking though that we could maybe there's some things that we could maybe do to get us on track. Actually, you know what we should do is that we should play Tetris. You want to play Tetris? Because that game I think does it for me. What time is it? 6:49. Well, they made a teeny tiny little move up, but back to where they were. I'm not sure I can trade this in this spot. I mean I feel a desire to take trades, but I'm don't feel very strong conviction. You know, like that was a pretty good downtrend. Wouldn't it make more sense to try and go for the rates raising again? I don't know. I don't know which trade makes more sense at the moment. Maybe we need to. Maybe if we wait, they'll give us a better hint about what's going to go on. Yeah. Now another thing is it's relatable. Yeah, but that's where I'm saying like I gotta find better ways to express my frustration when we do get to that point, right? Because I don't want to be saying things that are just like really demotivating, right? Like it should be relatable, but it should also be like, okay, like we can keep going now, and we can do this. So I'm gonna work on that. That's a Seth problem. But here's the other side of it. Was after I lost on that initial trade and I started whining and everything, I took a trade the other way. I made it all back, and then after the stream, I took another one and I made $20 on that one. And if I had held the two contracts that I had on the stream and like really held it, probably would have been like $50 or more. So yeah, my trading yesterday was amazing. In fact, somehow after all of that, it was amazing. I don't know how I did that. So I came back to it and I said, oh, you know what though, Seth? You are pretty good at this. Like what you're trying to do is hard and maybe it's not possible, but you actually are pretty good at it. If you're on the ball, you just smash it out of the park. I think I'm frustrated because I wanted to get the one where I'm in the trade and the big piece of news comes and I make the big money. It's been a long time since I've really caught one of those, and I really would like to catch that. So all that whining for nothing. Well, we're still changing some things, right? I was saying, I probably will not stream on most Mondays. So I think what I will do is on Sunday night, I'll leave a note as to whether or not we're going to stream on Monday or not. But I think that most Mondays we're going to take that as development. We had these time periods where I was taking Fridays off. So after the stream, I was working on the stream and not my regular work. And I got a lot of work done. And I've had a lot, like all of those order flow videos. I mean, I wrote and scripted those all out. And we just churned those out. Like I was thinking, with the way that I work, probably won't have all that stuff done until May or whatever. But we're already to like the last seriously planned content video. I would be able to record it this weekend, except for that my wife is doing job training, and so she's going to be gone from noon today until all day tomorrow, and I have all of the kids, like even the stepkids. So I'm probably not going to have time to do that this weekend. But what I can do is like clean up the script a little bit on Sunday night and record it on Monday morning. And do that instead of streaming. So that's what we're going to do next Monday, right? And I don't know what I'm going to do with the account here. We're fine for now. The account is almost 600, right? Almost 600. When we were getting below 500, that's when I was like, I don't know if I want to trade it anymore. I would rather sit and give myself trade sim for 10 months than like put more at risk right now. Because we spent most of our money, right, on the camera. So I don't know. I do want to, I'm hoping that we get a good bonus this year from my regular job and we build a new PC. I think that would be a fun video. And that seems like something that YouTube is really, really interested in. And if we built something that was like a real monster and showed that it was faster for backtesting, I think that would be really interesting and useful, wouldn't it? So, so we're going to change a few things. And again, like the other side of it is that I'm coming more to terms with the mental aspects of the trading that can be holding me back. What did you start at? Oh man. Well, so the account, when we first funded the account, it was 1,500, but most of the losses came from the oil fiasco, right? So I lost like $1,000 on oil, and then I put a little bit more into it. But that was like December, right? So the problem is not oh man, this is the thing that's frustrating, is that what's killing my account right now is the freaking data fees. Like if I'm only making like $10 on an average day, $10 to $20 on an average day, that $50 data fee ends up being a lot, right? So that's like $200 in data fees, and then we lost about 250 at one point in losses from being stupid, I guess. Not understanding this market. That's really what I think it comes down to, is like, if I understand the market really, really well, then I can do well. I should push it harder when I am doing well. But then I come into a market that I don't seem to understand what's driving it very well. And that, I think, is what's been happening in January, is like the interim periods. I'm thinking, they could probably buy bonds here. And it doesn't happen. And then when the big sell comes at like another event, I'm not able to take it. I'm not able to push and catch it, rather. Like, it happens while I'm not in a position, and I'm too scared to try and chase after it. So we lost some, but that's how we got to 600. Yeah. You have multiple feeds. I don't know what you mean by that. The data feed is just rhythmic, or sorry, it's just kinetic CQG. I really want to go back to rhythmic. I keep having problems. Trying to understand stuff. You had the idea, sure. Well, I mean, I understood. But I did that because I understood what was going on. Like that was the thing. Was at that point. Here's the thing about yesterday. Like, consider this. Think about this for a second, okay? The CPI number came in spot one higher than what the consensus expectation was. Okay. So is just a normal beat or surprise. It's just a normal surprise. We've had normal surprises like that before and had like a short-term reaction to it and then not gone anywhere. The reason the market reacted the way that it did yesterday was because everybody had so much expectations built up around it. I really suspect that the market overreacted to the news yesterday. I mean, that's going to be the tendency for them to do anyways, But I understood that. Like, they're freaking out because they had such big expectations, and it does matter a lot. We're like in a period of really high uncertainty for interest rate policy, and we just got a really important data point that was bad, right? So in that situation, I don't want to buy that. I tell you that much. I don't want to. I certainly don't. They're going to sell the treasuries, and whether the spot that I took was good or not, well, whatever. It's like, chances are, if you take a short somewhere in there and you hold it long enough, you're probably going to make money. So I understood that market well enough, Yeah, not my place to ask, but did you learn about markets in an insurance or a risk management? No. So here's how I learned about markets. I watched CNBC all day, every day for like a year or two. And then I went and I worked at Goldman Sachs for 6 years as in technology, equities technology. So we did have more to do with exchange connectivity than trading. I wish I had been able to learn more from the traders there. I wish one of the problems that I had was that I got to speak to traders and they gave me some information and they even told me about Almgren Chris. But I read the paper, I didn't get it. I didn't get it. It wasn't until one of you guys gave me that book by Jean-Philippe and I had the necessary background information to understand the significance of it, right? So like I could have been the point that I am now, like 10 years ago if I had known. And that's kind of part of why I'm giving some of this stuff, telling you some of the information that I am, because I think that we're making society level decisions, that are where this information would be relevant, or we're making bad decisions because people don't understand it. So that's why I want to share it, and then hopefully you guys can, you don't have to take the long route. You understand this stuff, from at least the main consequences on a basic level, and then you can go and you can understand the math yourself by reading the books. And then we can collaborate on it, and we can do like real, actual quantitative research, instead of indicator soup. So that's where I learned about markets. He was saying data feed. Yeah, no, I only have but the freaking exchange data fees are just so much. No, the Goldman traders did not really use technicals. So I remember, one of the things is it was so long ago, and like sometimes I come to this point where I'm like, I don't remember if that really happened or if I'm just making it up in my head. But one of the things I remember was, well, first of all, the girl that I was talking to, that I was helping, she did not know chart patterns. I had just learned chart patterns, and they did not look at that at all. I mean, they learned stuff. They knew stuff, like they knew what moving averages were and everything. But as far as I could tell, what they didn't use in their strategy. They didn't have some sort of setup where you would look at a chart and that's, it would predict what was going to happen. Like that was the thing, is the game that they're playing is very different, right? They don't have to predict what is going to happen because they have already made a transaction with somebody when they start doing their job, right? Somebody says, I want to buy X thousand of this stock, and I want you to execute it for me because I know that you will execute it better. That's basically what their job was, right? So they didn't have to have some indicator that would predict whether we were going to go up or down that day. They knew whether we were going to go up or down that day because they were going to be the one that was going to make it go up or down. So their job was not to predict the market. Their job was to have as little impact on the market as you're doing it as possible. So the game is different, right? And that's one of the frustrations, is with the quantitative research that you're going to get, it is more institutionally based. And so you're getting a lot of these edges and things that don't really tell you whether we're going to go up or down that day. Maybe some of the future research with this stuff on the inelastic market hypothesis, they really start digging into that stuff. I think that we will start getting more research on kind of on that vein. But yeah, it's a different thing. And one of the things that I remember was that she really liked it when you started getting candles that folded back on each other. You know what I mean? Like, they didn't want it to be like, yoop, yoop, yoop. I'm sorry, it was a yellow, wrong color. Like we like it if it goes up and comes a little back, and I want to get in here, right? That's what we like. But what she liked was like it goes up and then it kind of folds back in on each other and kind of does this sort of a thing, right? Because that meant that it was going to provide a location where she could take a lot of liquidity. You get what I mean? Hey, look, the 2%, it did happen. With it kind of came back, but I mean, there would have been like what? 5 ticks adverse excursion if we had taken it where I wanted to, but it would have worked. I don't see Twitter. Well, I don't think that you're going to see many. Like, that's the thing, is that the retail trading crowd is completely clueless about it. And it's understandable because number one, it's really complicated stuff. Like the math behind it is really complicated. And number two, I don't think that anybody really understands the implications of it as a retail trader. Like there are a lot of people out there that know this kind of stuff. Like Almgren Chris has been around for a long time, right? Almgren Chris was published in 2000, basically. So it's been around for almost 20 years now, right? But like the people that knew about that stuff, they'd never talk about it or tell it to retail traders because they thought, oh, it doesn't matter. Like it's not pertinent to you guys. That's like optimal execution, and you're trying to predict which way it's going to go here. So it doesn't matter. But then what I've done is now that I've understood all of this stuff, I'm learning what the implications really are for you. Like the inelastic market hypothesis, it kind of has some big implications because it suggests that all of these ideas, like I think the idea that the inelastic market hypothesis destroys the most is the idea of support and resistance. Because I do think like there can be situations where somebody decides to start buying or sell something like a big player based on a certain level. But what we learn is that the impact of orders is just so strong that you really can't rely on levels. You really can't rely on the price because these actors are price agnostic. And the data all backs this up. So all of our ideas about like here is balance and they get too far away from that, then they're gonna have to come back unless they accept the new price. It's all nonsense. The market doesn't actually work that way. Like maybe there's some things in the short term that might do enough to make you see those kinds of patterns, but the empirical data is that in the larger picture of things, that stuff doesn't work because the impact of new orders is so extreme. So really the only thing that matters is what the new orders are going to be and trying to predict those large meta orders before they happen. Right? Same with Almgren Chris. The impact of Almgren Chris is that you can kind of use it to time your entries. If you watch a large move, they're going to hold off and wait for the order book to recover before they try and make another move. So that's why it seems like you chase the move and then you just get caught and stuck somewhere. Well, you got to wait for the order book to recover and then try taking it. Then you won't be sitting in a dead position for so long. I think personally, I am done telling people what works and what doesn't. Have you seen? Well, but okay, so like, what works and what doesn't. So the problem is that that's all anecdotal, right? It really is a problem. Is like if a trader is using a method that is ineffective, and we have information that proves that it's ineffective or whatever, but they're making money on it, at least in the short term, there's no way that you're ever going to convince them to not do it, right? The thing is that you can have a lot of success in spite of all of those things, right? And another problem is that you can have a lot of success and not really understand yourself where the edge is coming from. There going to be a lot of people I really think this is the case with Mark Minervini. Everybody's saying Mark Minervini, he's a technical trader and all of that. He's trading penny stocks, guys. He's trading penny stocks. He knows just enough about what's going on with that penny stock that it could be taking off. somebody with Chat with Traders that's been done 4 years. I'll watch that. I've never heard of, well, maybe I have heard of Trillium. This was 2019. Well, 2019 isn't too bad. 8-figure years. Well, that's cool. Better focus on growth opportunities. Do you recall what technical indicators he was using? You're saying that it's not pronounced anecdotal? You want me to say anecdotal? Well, it sounds like the internet says that it's pronounced anecdotal. He doesn't say what it is. So here's the other thing that I find really frustrating is that when I talk about here's why technical analysis doesn't work, etc., 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 somebody will always come and say, well, except for that quant firms use technical analysis and they make money. And I'm like, yeah, but like your idea of technical analysis is not their idea of technical analysis. He does say pure TA is what he uses, and how he was taught. I don't know, man. again, and then there's the other side of that, which is like, if they're trading at a firm, probably they have been taught to also look at news and stuff, right? Like, but without really knowing like everything about his system, right? Because all we can do is if somebody lays out a specific thing that they're looking at, and then we can analyze how the market reacts to that thing and see what the edge might be in it, right? That's all we can do. If yeah, I don't know, because again, like the thing is if the what should we say the thesis here is that I'm making? How general should I make it? So if my thesis is technical analysis doesn't work, one person having success with technical analysis does not disprove the theory, right? Because there's enough randomness in the there's enough randomness in markets that people can have success with methods that aren't effective. Yeah, I can convert NinjaTrader 7 indicators to NinjaTrader 8. If you post them on the NinjaTrader 8 forum, you can, people will often do it for you, but usually it's not very hard. It's not very hard unless it's doing something really complicated. So I'm a little fuzzy on where it is, but my recollection is that in NinjaTrader 7, you have like these initialize functions and everything instead of like the on state changed function that you do in NinjaTrader 8. So generally speaking, what you want to do when converting an NinjaTrader 7 indicator is just find the main part of the on bar close function where they're doing the actual calculation, and just copy and paste that into a new NinjaTrader 8 function and create the series. And then that's usually all you've got to do. I was once told by an old pit trader that TA in his time was noting down big dogs and instruments and seeing at what price levels they were looking like they are going to throw up. Yeah, I think you could. Yeah, if you knew where they were taking the trades from. Oh, did I miss? Did I miss? Was all of a sudden was seeing? Oh, never mind. I was Steven's name shows up green over here, and I was like, oh, wait, why is he green? Oh, then I remembered. Oh, right, that's the subscriber color. No idea when it became crayons and line on chart. But that's that's the nature of the technical thing, though, right? Is what the research suggests is that technical edges can exist in the market, but they're extremely easy to arbitrage away. So they don't last for very long. And this is why companies like Citadel, keeping it quiet, not telling anybody about it, and knowing how big the edge is so that you size the trade appropriately is really, really important to not eliminating that inefficiency from the market yourself so that you can keep trading it. And that's how, like Renaissance, for instance, is able to continue to use these things. But the split side of that is, again, I don't know what technical analysis is to Citadel I keep saying Citadel. I mean, I think I understand where Citadel makes their money quite well, actually, but Renaissance, I have no clue what they're using. And it's probably some very advanced math that is very, very different from support and resistance, Well, if you just send it to me on a Discord, I will take a look at it. I'm very so I really like to help you guys with programming, but the one thing that I don't like is when people want me to just do it for them and they're not trying to learn how to program at all. But converting an indicator from NinjaTrader 7 to NinjaTrader 8 is totally different situation. And you're a subscriber, so I definitely will take a look at it and do it. And as long as it's not doing anything really weird and funky. So weird and funky would be like it's drawing special kinds of things on the chart, or it's doing stuff with order flow. But then even then, it's usually pretty easy for me to convert. The only one that I ever had a hard time converting was the augmented Dickey-Fuller test indicator that I made. Somebody made it for NinjaTrader 7, and I converted it for myself to NinjaTrader 8, and that was difficult to convert because they had to do stuff about what if because it's a correlation between two instruments. So that's another one, is if it involves multiple instruments. You have to worry about what if this one has a data point and this one doesn't, and how you deal with that. And the way that he was doing it in NinjaTrader 7 was essentially like things that NinjaTrader 8 did for you. So I had to take out a lot of his code to get it to work. But I did get it to work. I didn't really do much with it. It was interesting because it was a very computationally expensive indicator. That's probably one that would be better done through TensorFlow. Yeah. The tensors would probably compute it faster. Well, after a pretty this is kind of interesting, actually. So they had a pretty aggressive push down here to the lows, and they're already back across the range. So they're trading 6 to 11 tick ranges right now. And it's pretty choppy. I mean, it's slightly up, but it's a very wide range. It's very choppy. Not necessarily the best kind of action for myself, is it? This one is, it's a few thousand lines. Oh dear. Wait, what is it doing then? What kind of an for a few thousand lines, this better be like a footprint chart or something. Good grief, man. I don't know if I can take a look at it, but I can't make any promises. Yeah, if I like, now would be a good time for us to take a look at it if you can send it to me, and you're okay with people on stream seeing what it is. But given that it's an indicator that already exists out there. What's going on here? Paolo Arduino. Yesterday was a historical moment for Tether. In 3 weeks, you'll understand why. And that was on the 11th. That was today. That's today. Oh, jeez. And then they show a picture of people in El Salvador. Tether is going to print a bunch of fake money for the El Salvadorian government so they can avoid extradition to the United States. They're spoiled your announcement. He's speculating, but it'll be interesting to see what that is about. Did you drop off? I didn't see. Anyways, I think the place where you might have left off, Luke, was this where I said, if the thesis is technical analysis doesn't work, one person having success with technical analysis does not disprove the thesis, because we can't actually see, we can't analyze their strategy empirically. If they come through and they say, here's my strategy, and they have it all programmed up for you, and we can go and put it in our NinjaTrader 8 strategy 8 thing and back test it and see what the performance of that strategy is, then we would be able to go in and say, okay, over the last X years, this is how it performed, and that is good, right? Otherwise, we kind of have to chalk it up as myth, because he could be saying that his technical analysis and the reality was that the edge was completely coming from somewhere else. How do you know? Man, these ranges and the ZNs suck. I'm really nervous about. I mean, I could take some sim trades because I kind of do want to trade it. I suppose if we come back to, I'm gonna have to. So first of all, we'll switch this to. Oh, not that one. Yeah, let's do that just so that I don't misclick something. But this one. Okay, there we go. So when you get that, then I'll take it. I consider money flow technical analysis, and isn't that the thesis? This is a good question. I'm going to say no. I'm going to say that money flow is not technical analysis. So like, the definition of technical analysis is really amorphous, isn't it? Because on one hand, I think the idea is that technical analysis is the analysis of the markets using purely market generated information. I think that would be a really great way of describing things. I think that that's the way that we should describe things, at least, is where did the information that you're using originate from, and what kind of analysis are you applying onto it? Notes on charts, and dissecting everything on those charts. Okay. So if we call technical analysis everything that has to do with market generated data, okay, well, that what you're saying there might be pulling out some information from elsewhere. Okay, might be. He trades capitulations. Well, that might be a thing. Is money flow order flow? I mean, I don't think it is. I think when I think money flow, that's the word term you use is not really defined at all, right? When I think money flow, I'm thinking about where money is coming from and to, right? But I haven't seen that to be predictive per se. Um, but yeah, I think that if we're saying technical analysis is just purely analyzing market generated information, then my thesis is that it's possible for you to find an edge through pure technical analysis, but you're extremely unlikely to find it. Okay. If technical analysis is the analysis purely of a market generated price on a single instrument and analyzing it by seeing whether price went higher or lower than the previous swing, then I'm going to say my thesis is that straight up doesn't work. And I've done a lot of back tests around that kind of stuff. And as far as I can tell, it straight up doesn't work. I think that the larger trading community thinks that these sorts of things work and is really convinced by these sorts of things, in part because they're very difficult to back test, or they don't know how to back test them. And the answer to this is that you need to use a zigzag, but you need to use a zigzag that doesn't redraw. You need a zigzag indicator that doesn't redraw. So once we've come back more than X ticks, then you've had a zig and you can take a trade, right? You have to have a definable point at which you've said a pivot has occurred and I can take a trade now, right? But once you do that and the zigzag indicator has all the logic to do it, I like to do it as if you get a close high where the close is higher than the previous bar's high. I find that one to be real, more effective way of doing it. But whatever, you can backtest all that sort of thing, and I'm just saying, just based off of higher high, higher low, or double bottom, or all of those sorts of things on swings, they do not work. You can't backtest context. But now what was okay, but that's exactly the problem that I'm talking about, Lucas, right? If you can't backtest context, how do you know that the way that the higher highs and higher lows are behaving is where you're deriving your edge, or whether it's the quote unquote context that you're actually deriving your edge? Maybe if you just traded purely off of that context, which is, what the news is for the day and things like that, maybe you would make just as much, if not more. Right? Now, if the context is like other technical things, then you should be able to include those in your backtest, right? You'll get less samples though. And here's another good example of where we fall into these statistical traps, because the more qualifiers and filters that we have on our setup, the less setups that we're going to get, the smaller of a data set we're going to have. So if we had some success, but it's on a really small data set, right? You're going to think that it's going to work, but it's not until you have 10,000 trades or whatever that you see that, it was just random, right? Which layer on the brick wall makes the wall standing? That's not necessarily true. What did they use in the pits? Well, I think that there was a lot of things that they used in the pits that we can't use. I don't think any serious TA trader claims that they only use one variable. Well, yeah, but if they have like a full setup, then we can analyze the full setup. But again, how can you prove that any one of those, that the whole problem is technical analysis traders, one of the ways, how do I present this to you without being like a total asshole about it, okay? Gurus out there that are teaching technical analysis intentionally make their setups non-back testable, because if you back tested it, you would know that it doesn't work and you wouldn't buy their shit. They make it vague on purpose. And the price action guys are the worst culprits, okay? Some of these rooms, man, I don't need to name names. Y'all know who I'm talking about. There's the top price action guy. You go into his room, it's total nonsense, everything that he says. Everything that he's saying it really seems to me like he knows that it doesn't work. And he's just trying to make as much money out of the freaking subscribers as possible. Man. So I read some stuff on them, and first of all, they use like very esoteric language that's like very specific to like their version of price action. But then like he never really like makes calls. It's just like he does something, and then when it works out, he's like, oh, see, we're so brilliant, it works. Whereas I'm kind of like, oh, I don't really know what's going to happen. I kind of feel like doing this, and sometimes it works and sometimes it doesn't. And I don't really keep track of how good my read is, really. Only the trading, and when I do the trading overall, I would say that it's pretty good, but I still have like really bad periods of poor decision making. And I think that happens because I don't understand that market, because the edge that I'm pulling out is largely derived from the fundamentals, and well, not even just fundamentals, but things that I can try and predict future orders. So that could be fundamentals, that could be understanding the strategies of large players, that sort of a thing, right? It will go up or it will go down. No, I when I make these calls, I'm pretty specific, right? I said I think that I can take it short from 0.15 and try and get 2% even. And they did do it. There was more adverse excursion on it than I think I would have been comfortable with for actually being in a trade, but they did touch it. And I did take this sim trade here. So this sim trade is based on the range. I think that on the day that we will eventually move up. So I kind of put my orders just a little bit outside of the range for just in case we get lucky. If it's screwed, you fix it. But yeah, but again, how many samples do you need? Right? Like it's not just that these methods are not empirical. It's that even if you try and take an empirical approach at testing them, you find out that you don't have enough data. And then when you do get enough data, when I've actually it's situations where we're really able to push it, then it doesn't work. But okay, I missed the explanation about adverse excursion. Adverse excursion just means that you took a position and price moved against your position a certain amount, right? So if one way that you could try and sniff out that somebody's strategy does not actually have edge and is really just taking on excessive risk would be comparing their adverse excursion to their favorable excursion. Favorable excursion is how many ticks in your favor did it go once you got into the position. Adverse is how many ticks against your position it went once you got in, right? What do you think about the anti-RSI? The anti-RSI was a joke, John. Yeah, it's MAE. Maximum adverse excursion. Isn't that what I said? Yes, it's MAE. So if a person has a predictive edge, then their favorable excursion should be much higher than their adverse excursion. they're picking good spots, right? Or they have good risk reward ratio, right? There's a live trading room where this kid started with 500 and he's near 15K who uses TA. He has a high win percentage and it makes 3. Yeah, I'm sure. Yeah, like that's exactly the kind of a situation is that generally speaking, taking on risk. Well, I mean, there's multiple ways of doing it, but the way that most people do it is you modify your strategy so that the kurtosis or the fat-tailedness of your strategy is higher. And what that means is that the win streaks that you have will look better, and people will be attracted to you if you're out trying to, you know, do the marketing and everything. You're doing marketing, always coming in and winning looks really good to the room, right? But there's fat-tailed nature to that sort of a strategy. So what you will see for those kinds of guys is they'll do really well for a while and then they'll blow up one day, right? Or in the case, another one that I've seen happen, and might be the case with this guy that Live Action is talking about, is if you're only taking $3 a trade, that means that the losses are not going to be write-offable on your taxes. You're going to have to pay the full tax for every profit that you've made without ever being able to discount the losses because you're trading stocks. So he's going to pay a massive tax bill because of the wash trading rule. Unless he somehow is able to switch what instrument he's trading every time. You get what I mean? I was taught price action analysis is asking a chart to show you patterns, but technical analysis is everything outside of fundamentals, not trying to nitpick. Well, yeah, that was a good. I think that is what they do. Like, to me, or at least that's my perception of it too. I guess I'd use slightly different language. It seems to me that technical analysis is using things outside of fundamentals, or I like to say market generated information. As I think a better is like in more, this is what it is rather than this is what it's not. Market generated information. Price action, it has more to do with did we make swings? Did we make a higher high, higher low? And like the extent of those, like this bar was really big and this bar wasn't. So price action is like the movement of the individual bars on the chart, as opposed to trying to do look for a big pattern, like a big long-term pattern over the whole chart. The price action people don't like those, or having a lagging indicator on there. Even though you got to realize that all of the data that you look at is past data. That's not necessarily the only way to. The charts are market generated information. Just crayons and lines. Yeah. And I want to make it very clear. I'm not saying that you shouldn't have a chart, right? You should have a chart. It's just that you got to realize that what the chart does is it shows you what happened. You need to understand what happened so that you can understand what the current situation is, so that you can understand what the range of possibilities of what might happen is, or are rather, and take the things that you have that actually are predictive, to be able to understand if those things that I can predict do happen, how will the price of the thing react to it, right? So having the chart is important, but as far as I can tell, the chart does not have any predictive value, which is to say that if you go and you take a certain setup and you can put all of the filters and qualifiers that you want on it, but if you take that particular setup and you put it over 100,000 trades, that it will basically be break even. So I think everybody wants to say we could get more specific, right? This is where we can pull out the programming. Not that one. Strategies. If I can remember which folder I put it in. There it is. Okay. So let's do this one. This one I think is a little bit better. Oh man, trying to explain this code to you might be a little bit difficult. What I'm saying is, when a pivot is confirmed, if the pivot low is equal to the previous pivot low, that is a double bottom, and I will take a trade off of that double bottom. Okay, that makes sense. Strategy analyzer, pull that up. I'm going to take this back as far as it will let me go. So I think I can go back to 2008, maybe January 2008. ES, right? And we're going to come in here. Where was it? MGMT. There we go. No, that's not it. Oops. My builder strategy. ATGN. There it is. Okay. Double bottom pivots. Okay. So this one, use doubles, means that you have to have a double bottom. Okay. I think this is the settings that we did. We can do it on let's do it on a 5-minute chart. That'll just be a little bit less stuff to run. It's easier to trade those reactions. But again, you're still making a prediction though, right? You're saying when you see something and then it reacts a certain way and then you take a trade, it should continue or do it or whatever the thing is, right? Can you get that indicator? No. I would have to talk to John. I haven't seen John in a while. I don't know what he's up to. When I really started going like really far anti-technical analysis, he stopped coming around. Because part of what he liked was back testing all of those things, and I just got fed up with it. Like, he gave us a lot of really good ideas, but it's just like every time that we really started to get serious into it, it was like, no, actually it doesn't work. You just need more samples. That's how do you know that? Probabilities of something in the future working out are higher when you have further confirmation on conditions. Well, so the way that I think of what you just said in a programming context is the more filters that you have on it, the better, more predictive it should be. And what my own experience has said is that having more filters on it doesn't necessarily improve or change the probabilities of things at all. All it does is decrease your sample size and make you more likely to be fooled by the randomness of it. it's been on my mind with my strategy. How can it be shown to be effective if there's not enough history to backtest 100 iterations, weekly candle trend stuff? Exactly. You know where I initially kind of came to this conclusion or figured this out was backtesting candlestick setups. So one of the setups that we were looking at had to do with inside bars and outside bars. During the QE section or phase of things, you could trade these inside outside bars, and it was like really awesome. It's like if you had an inside bar, it would like there'd be an inside bar, and then it would break out one direction, right? And we would wait. And if it then failed and came back to that inside bar, then I was taking the trade on that, and it worked really, really well. But then in 2020, like later 2020, it stopped working essentially. So we're like, oh, okay, there's these drawdowns. There's these drawdowns and they're pretty ugly. Okay. So then we said, well, what about every candlestick pattern that there is? So we went, and NinjaTrader has a lot of candlestick patterns programmed into it. So we made an indicator that backtests literally every candlestick pattern there is and just said, okay, just take a trade on that candlestick pattern, right? And we would run all of them on the last year and see which one worked the best. And there was one. What was it? What was the name? What was the name of it? I can't remember the name of the candle, but it was like a really simple candle setup. Was far and away in that year the best one, right? So then I said, okay, let's take that one and do a bigger backtest on it. And so then I would go back and try and do it back to 2008. And it was random at that point. So it was like, oh, if I took a year's worth of data, it worked 60% of the time. But then when I took 10 years worth of data, it was 50-50, right? And this is how I learned these things. No, you're arguing with a bias towards your way of watching at the markets. No, I'm not. Look, if you have a setup that we can program in backtest so that I can prove to you that it doesn't work, then explain the setup and we'll backtest it and we'll show you the problems with it. But I'm telling you, almost every situation, if it is a purely price-based strategy, then the most likely scenario is that you're being fooled by randomness because you just don't have enough samples. That's almost always what happens. That's what happens to almost every retail trader. And what will happen is if you start having enough success with that setup, the market sniffs it out and then starts trading against it. You can backtest the setup. Look, you can go and you can say higher high, higher low, backtest the setup. Okay. You can even go and you can even use fundamentals. There are ways to do that too, but how can you say that it has any efficacy at all if you can't even like define the setup? You know what I mean? Like if it's discretionary trading, like all you're saying with discretionary trading is we have to forward test it. And then what? Okay. How well did you do with it 5 years in a row? Okay. Well, yeah, but how do you know? Again, Lucas, how do you know that it's the setup or the context? Right? You're taking a trade in a certain situation. You're saying, well, when the context is like this, like we're on a trend day because there was big news, and I'm taking this setup and it works. And I'm saying, how do you know that it has anything to do with that technical setup? You could maybe do something completely different. And if you're just saying, I want to trade in the direction of, rates are going up because a member of the Fed just said something crazy, or because there was a really high CPI print, right? That's the edge. Why can't it be both? The problem is that you can't know, right? But here's the thing. If you have a strategy where you're using a technical setup and context and you've been profitable with it. So that's the first thing is have they been profitable with it for a reasonable enough long period of time? Because I don't know what the deal is. And I don't think that that's you, Lucas, but I get all of these retail traders that think that something worked for them for a month and then they've figured it out. And it is not like that. Like if you can do it for 5 years, then good on you. But even 5 years might be too short. Okay. But if you do a setup and you've traded it for 5 years and you've made money on it, okay, and then we go and we take the technical side of your setup and we just test the technical side of the setup without the context, and the technical side of the setup is break even or negative, then what does that say about the strategy? Where is the edge coming from? Is it really coming from the pattern or is it coming from the context? And like the reason why I think it comes down to that is like the information that we have suggests that the context can be really predictive and the technical stuff generally isn't. The technical stuff is generally random. By the way, I need to pull that up there. There you go. Does that make sense? Can't backtesting for anything that the market is constantly changing. Well, so one of the so this is where you start to get into the layers. This is where it actually gets cool to ELA, is that what you can do is you can say, I have a strategy that changes, right? You can say, I go and I analyze the market, and based on my analysis of the market, I start trading this, and this is how machine learning stuff works. Okay. So I went through all of that and it didn't take any trades with the parameters that I had set up. Or am I just not? Yeah. Output. Did I not have use double set? I'll run it again. No, but you're okay. You have to define context. Okay. If context is we had a CPI print yesterday that was really high, and that's context, that's one thing. If context is we're like at the high of the day, that's a really different thing, right? Right. So if your context is data not generated by the market, then all of a sudden you're introducing a variable into your strategy that is non-technical. So if that strategy was successful, you cannot say that it was from the technical analysis. Unless you have like two, I mean, it's not, you can't do that scientifically, right? So then what we do is we change it so that it can be scientific. We say, okay, well, let's just take all of the things out of it that we can't backtest and just backtest the thing that we can look at. And we look at the thing that we can look at and it ends up being random. And they say, well, it's because you need the right context. Okay. Why is it that it always has to come down to a claim that can't be scientifically tested? Well, I don't. You might say that, but that is not what the majority of people say, Lucas. No profitable trader, despite the method they use, disregard context. When arguing if TA works or not, we are arguing that if profitable trader uses TA apart from context or order flow context as much. Your opinion is not the dominant opinion in the technical analysis world. The people that use and teach technical analysis teach you that you don't need to know anything about the market, that the chart tells you everything. Like that, this is the thing that gets, this is why most fails, right? Yeah. This is where it comes back to, like, let's look at what we can prove, right? Let's look at the quantitative research on stocks and so forth that we can prove, right? And what we can prove is that markets are very statistically efficient. Like, but this is why I really think that the next video that and you guys that watch the stream, you already know this stuff, but markets are inelastic. The inelastic market hypothesis destroys the efficient market hypothesis. Because again, here, let me, where is this? You're gonna find the right spot in this book. Here we go. This is the granddaddy. Okay, so if we're gonna say what is technical analysis, this is classic technical analysis. Price action is not classic technical analysis, but it is technical analysis by a different name. Okay, the technical analysis of stock trends, page 6. Actually, I think I'll have to start on page 5 here. Moreover, the technician claims with complete justification that the bulk of the statistics which the fundamentalists study are past history, already out of date and sterile, because the market is not interested in the past or even in the present. It is constantly looking ahead, attempting to discount future developments, weighing and balancing all the estimates and guesses of hundreds of investors who look into the future from different points of view and through the glasses of many different hues. In brief, the going price as established by the market itself comprehends all the fundamental information which the statistical analysis can hope to learn, plus some that is perhaps secret from him, known only to a few insiders, and much else besides equal or even greater importance. Okay? Technical, if we really want to get down to the heart of technical analysis, the philosophy behind it is current price reflects all available information. And that has been empirically proven false. There is more volatility than there is actual changes in fundamentals. So then we'll say, well, why is that? Well, it's because people trade randomly, etc., etc., etc. Right? That was like the theories. That's how the technical analysis guys justified it, right? So the researchers started to test those theories. And what did they find? They found that the orders have such a drastic impact on the price that current price reflecting all available information is impossible because the orders move it too much, right? The inelastic theory of markets basically destroys the entire premise of technical analysis. And it explains why technical analysis tends not, even if you go beyond that and you say, well, current price doesn't doesn't reflect all currently available information, but there can be tendencies in the markets that you can pull out, right? In other words, think about it this way. There's like, let me write it on here so I can kind of keep my brain straight. There is statistical efficiency and there is informational inefficiency, or informational efficiency rather. Okay. Statistical or technical efficiency, you could call it either of those things. Okay. Or informational inefficiency. Okay. The premise of technical analysis is that markets are informationally efficient and are not statistically efficient. That is essentially the premise of technical analysis, right? Current price sees all available information, but despite that, there are still trends and statistical aberrations in markets that you can take advantage of. That's the premise of technical analysis. The reality is the exact opposite, actually. Orders have such a strong impact on prices that markets cannot be informationally efficient because those orders will always move markets away from their fundamental value. That's why markets have a tendency to either overreact or underreact. It's because of the effect on order flow. But the effect on order flow also means that if a statistical inefficiency is found and they can exist, they get arbitraged out very quickly. So the market is not informationally efficient and is somewhat statistically efficient. Let's not even say somewhat. It's very technically efficient, but it's not perfectly technically efficient. Okay? That's what the research says. Like that part is proven. I guess when we talk about the inelastic market hypothesis, that is still a theory to some extent, okay? But there is empirical evidence behind it, and it's the best explanation that we have today, okay? That's what our research tells us. So why are we going to waste our time with a way of looking at markets that contradicts what we know? What's proven? Current price does not reflect all available information. So why should we listen to people that say that their entire way of looking at markets was built on that premise? And then we come back to this thing where it's like, well, here's the setup, but you can't backtest it. I was like, good, then why should I waste my time with it? Like, here's the thing. If there was this school of teaching that they had dozens of traders that had come out and made money, and all of them had consistently made money day trading over the last 5 years, right? That would be super interesting, and we would want to look at, and that might be worth trying. It doesn't exist, guys. The best I can find is one guy here or there that did really excessively well. They claim that he factors technical analysis into his trading to some degree. Well, okay. Maybe he has some ideas about markets that are wrong, but he actually has some edge somewhere else. That's what, with what we know, is the most likely scenario, right? How do you backtest news releases? Okay, so here's how you backtest a news release. You have a Bloomberg subscription and you connect it to their API, and then you can look at all Bloomberg news events, and you can backtest when the market reacted to those news events and select those as the situations in which you did something, and then you could go and do the technical analysis around those particular news events. And you could even go through and say, what you could use machine learning to determine whether that thing should be bullish or bearish and stuff. How can it say the market is not efficient informationally as a bad thing and you see it as a good thing? Well, for if we're going to trade, informational inefficiency is good for us because that suggests that there is inefficiency in the market for us to pull out, right? But it's bad for the investor because it means that the price that they get might be a bad price, right? So with today's Fed monetary policy report, I don't know if that one is ever something that really moves the markets, to be honest with you, FTH. It's not even listed on my calendars. I mean, I know what you're talking about because you brought it up the other day, but I don't know if that's one that the market will react to. Okay, so now that I added it in there, now it works. So now you can see the efficacy of this strategy. Period. Reward 1, stop 2. Probably need to go bigger, but if we come over to the chart here and find an entry, hopefully. Okay, so let's look at this one, for instance. This is what I wanted to get into. Yeah. Oh, but why is it there? I don't think I have the right settings. No, I do. But why is it on this bar and not this bar? So it should be double bottom, tick up, but if markets overreact, how can you account for the overreaction? Okay, so in my framework, what you want to do is, to us, how big the beat was, it isn't necessarily the key thing, right? Like I can't come in and say how big of a beat or a miss was it, and that's how far the market should move, because that would be a fundamental approach, right? That would be saying the market is this far off from the fundamentals, therefore we should correct this much, right? That's wrong. What matters? How many people are going to trade it? That's what matters. How many orders is this going to create? So really what it comes down to is how many people does this data point affect, right? So if you have a data point like yesterday where this data point is going to change, have an effect on what interest rates are going to be for the next year, that's something that affects basically everybody in the market. So you know that when that piece of news comes out, regardless of what it is, and even if it had come in line, there's going to be so many eyes on it and you're going to get so many orders on it that you're going to get a lot of movement. And then you have to be able to sort out what people's positions are and what the actual news was and the implications of the news to determine, which way those orders are going to go. So that's why, like yesterday, it's an easy call. Inflation was higher than expected. That means that the Federal Reserve is going to become more hawkish, and that is bearish for treasuries, and you can just sell it almost without question. Like, that's the thing, is like, yesterday is a great example. We have somebody, and they come in and they say, well, I made a ton of money yesterday, and it is because of the combination of me using my technical analysis and the context. And I say, you know what? I don't give a shit what your technical analysis is. If you went short yesterday in the treasury, you made money, probably, right? It's almost like, how can you even say that the technicals matter at that point when the order flow that's going to come through because of that news is so insanely strong? You're falling in the same trap of TI mean reversion by claiming you know fair value and then you can trade overreaction to it. Yeah, but we're not saying that we know fair value. What we're saying is that we can look at the piece of news and predict how many orders are going to come from it. Right? Should I have taken both of those contracts off? Yeah, I'm going to take the other one off of the 03 because that was the trade. It was a good trade. It was a good trade. How many adverse ticks did I get on that? Hold on. It actually went 4 ticks against me. Wow. Well, it wasn't the best pick, but the general idea of the trade was good. I tried to trade MES and mini NQ. It's so tough. Has a strategy section built into it? I don't know about that. Anyways, what I'm saying is you can use information outside of market generated information to predict future orders in some situations. That's my claim. That's my claim. Predictors of order flow. They exist, especially on large time frames. On large time frames, listen. If the Federal Reserve started quantitative easing today, I'm telling you what would happen. The S&P 500 would move up. Over the next 6 months, the S&P 500 would move up. The rotation of Earth is a limit to informational inefficiency. People sleep. But listen to what I'm saying, Wanderer, because this is really key. The way the market works, and when I say the way the market works, I mean like the mathematical properties of a limit order book make perfect informational efficiency impossible. In fact, to some extent, they make markets very informationally inefficient. There could be all sorts of other reasons, but all of those things would not matter because the actual thing that we're using to trade with has its own problems. You try and send it to me? Okay. How would you analyze accurate people's reaction to real time? Well, I didn't say that it's easy, but in some situations you can do it. Yeah. Any comments on using lock in an indicator? I don't know what that is about. That might be some sort of thread thing. I don't know. Anyways, this is one last thing I should say before because it sounds like you guys are ready to move on to something else. But I said this in the last video, right? At some point in trading, you're going to come to a point where you have to make decisions based on incomplete information, right? Like the reality is that this seems to me that the strategies that are really good, you're not going to be able to perfectly backtest, and you're not going to have enough data to backtest it, even if you had the sophistication necessary to do it, right? But at the very least, the premise of the idea behind why you even want to take that trade should be based on something that's real, right? Like it's this idea that some people have where it's like, I just rake the market for some sort of a pattern and then I start trading and I don't necessarily care why that pattern exists or anything like that. is it's just up to chance at that point. It's like, okay, you can start trading it, but there's no way for you to know whether there's a real inefficiency in there or if you're being fooled by randomness, right? Whereas if I actually study the market and understand how the market behaves, the things that we've proven that the market does, and we base our trading off of that, I think you stand a much better chance. And what does the data say to us? The big, the summary: markets are somewhat technically efficient, but are not very informationally efficient. So if you are looking for an edge, you are more likely to find that edge through informational inefficiency. Now, the downside of the informational inefficiency is that informational inefficiencies can be kind of unreliable, right? You've got to have an order flow in line with you. That's why I wait and I say, this is what I think is going to happen, but I need to see some order flow confirming it. I need to see that the flow that I think is going to move it to that place is actually starting to happen. That's why I do it that way. But you're more likely to find edge from doing that than you are from raking the market, guys. That's just what the research is. And if somebody has found an edge through technical analysis, I'm sure that there are. And they're just saying this guy, he made like 8 figures, right? I'm sure that there are. But guess what? There's going to be like one of them out of the millions of people that tried. And that's in line with what we know about the market. You have to be a little sick in the head to want to trade by predicting the future to some degree, more or less. It's all we are trying to do to want to live. Yeah. So do you remember, Lucas, when we used to have these arguments about what is the difference between having a strategy that is trying to predict the future versus one that is just taking advantage of a risk reward ratio sort of a thing, right? And I was always saying, well, to some extent, you're always making a prediction, though, right? Your prediction is that even though it might be less likely to happen, if it does happen, it's going to move really far. That's the prediction that you're making. You're making a bet based on some sort of expectancy, right? But if you're taking outright positions in the instruments, knowing which way it's going to go always ends up mattering to you, right? Because you can't get away from the adverse excursion. So I think that it's possible to take a trade that is based purely on risk reward sort of concept. But I think that if that's what you want to do, you should be trading options. Because in options, you have control over the function. You have control over how much you make or don't make based on what the underlying instrument does. When you're taking outright positions, you can't do that. What if the flow you found contradicted your news happened every day? Yeah, totally. Then you probably should stop trading it. But you know what I think was happening, NASDAQ killer, was last week we weren't necessarily getting news. We didn't necessarily have setups that we thought were really super predictive of what the order flow was going. I think that what was happening the last 2 weeks, for the most part, aside from like yesterday and last Friday, was that I was trying to take trades off of in a situation where I really didn't have enough of an edge and enough confidence in the setup to really be taking it. I think that one of the things that I'm struggling with is understanding the situations where we have edge from doing this. And if the kind of thing that we're going for, I think that we really have to have a really strong driver to justify taking a trade. Like, I'm starting to think that, like, oh, Seth, like, only take trades when when the market is really active. That's a little scary to me because, number one, that might not even be every week. Number two, you're always going to be trading at the most stressful times. But it seems like those are the situations where we have a much better chance of predicting the orders. Yeah, ultimately boils down to making some sort of prediction one with different degrees of probabilities. Yeah, because when I go and I look at something that is like just risk reward based, like in the S&P 500, right, is like it always comes out to, when you really do all of the probabilities, you're just taking on risk, and eventually you're going to run into a fat tail that destroys you. With options, you you can make a kind of a different kind of prediction, which is that the price of the option is wrong. I know that's probably not even the way that I should present it, because you can come in and say that the fundamental price over here is too low or too high or whatever the deal is, right? But it's different in an option, because in an option, what you're saying is this stock is going to move this much within this period of time, right? And you can come in and you can say the probability that it is going to move beyond that amount within that time period is higher than what the market thinks it is. And you can set up a strategy that gives you a risk reward position based on that inefficiency that you found. And so you don't quite have to make the same kind of prediction as, like, because here in futures, and especially with a small account, you literally have to say it's going to go this direction and it's going to stop within X ticks of this location. Right? FOMC conference was quite strong news though last. Yeah, it was. Yeah, I didn't really trade the FOMC though, right? I traded the non-farms was what I was talking about. Was it the non-farms? I didn't even remember anymore. I wish we had better memories. Well, I made a good trade there with the treasury, but it looks like there was a little bit more in it. It wasn't like I won, but it wasn't the most efficient thing. It's like MAE 4, MFE 6, MFE could have been 8. It could have gotten 8. How will Kamala's meeting go with NATO? I don't know if it matters. The latest polling results for the administration are so bad. That's just going back to what we started this stream talking about, right? The Democrat Party had a theory about inflation, and what actually happened did not match up with their theory of the world. They're trying really, really hard to explain it now. I think they're in denial. I mean, the Republicans, we're all sure what it is. You can't throw that much money into the economy and not get inflation. But now the Democrats are trying to say, well, it's not inflation, it's just companies randomly decided to be more greedy this year and raise prices on everyone. Okay. Well, they're coming back a little bit. So, something else I want to talk about? Why the heck have the treasuries behavior been so shit lately? It's just such a simple explanation for small brain Democrats that just follow orders. The people on TikTok that are arguing with me, I don't think have a very firm grasp on economics. They don't. Because the argument that they're making to me is, well, how can that be if companies are making record profits? Guys, have you ever had a situation where a company's doing really well, they're making record profits, and so they decide to reduce prices? That never happens, guys. Never happens. You think about it and you realize how ridiculous that is. It's like, hey, if people really want our products, shouldn't that mean that we should charge them more for it? That we'll make more money if we increase the price of the products? Come on. Yeah, I mean, okay, when I mean shit, like, look at this chart, man. It's like lots of swings across a very tight range. I guess today the range is pretty long, but if you were looking for some sort of a breakout, you were not going to make money, right? You had to trade this with some sort of mean reversion strategy for this to work out, which is probably was, or at least what I did, and how we made money from here to here was saying, I think that it's going to move up today, so when it's near the last swing low, I might take one. And of course, I'm going to be over here looking in the order flow for people leaning, right? But I don't like that. Like, I don't know if I would take that trade on my live account, because I haven't had very much success trading that kind of a thing. Like usually what happens when I try and make that trade is I'll come in here. Well, in this case, I took it right there at like 0.5 was it 0.5, was it? Oh yeah, it was right here. See, I thought that it was going to come to here, and look, it went way further. And if I had decided that it was going to come all the way back to these pivots, then it would have gone to like 29, you know? Yeah, it's kind of like there have been days, like there are days where it's just like almost too wild, right? And the swings are wider than I'm maybe comfortable with. And then there's days where it like barely moves 6 ticks. The ZN does. That's happened too, right? Like the chop and the mean reversion, and it's different. It provides some opportunity, but it's very different from the way that it's traded in the past, and I think that it's difficult to trade. And it's not like one of the things that you'll see happen is like, I think that like let's categorize strategies, right? One category is, what is the piece of information that you are using to base your strategy? Because all trading comes down to taking a piece of information, doing a certain set of analysis on it, and then submitting a certain set of orders based on that analysis, right? And then continuing to analyze once you're in the trade and making other decisions after you're in the trade. That's the management portion of it, right? So those are all parts of a strategy, right? But then another way that you can categorize them is on whether they do better in a mean reverting market or a trending market, right? And so what you will often see, for instance, I myself seem to lean more towards a trending strategy, right? If we're looking for some sort of an informational inefficiency, if the market is going to mean revert, what is going to be the predictors of order flows that we're going to get that are going to tell us that it's going to mean revert, and then it's going to mean revert in this specific location? I'm not so sure about that, right? So I tend to prefer the trend. But the thing is that if you had come in here and your strategy was mean reverting, you would have had days where you'd done okay, and then you would have had days that you had done terrible, because this market has been flipping from extremely mean reverting to extremely trending very, very quickly. Right? That's what bothers me about it. And then when the trends do come, some of those trends have been a little perplexing, I think. Like, what was the one that really threw me off? I think I come back in here. ZN. It was non-farms that I was like, that really screwed me over. Now, was this February 1st? I think it was. There was February 1st, and then there was the Thursday before non-farms. I was also like, what? It wasn't shitty fiscal policy. It was the evil corporations that make Congress people. Some people I just don't think. It's when you compare the economic knowledge of different parties is so weird to me. Because on the Democrat side, I see so many people that just don't have an effing clue about anything economics. It's like, I have a friend that from weightlifting. I know her from weightlifting. She's a better weightlifter, way better weightlifter than me. She was going to naturals and all this sort of stuff. And she has started becoming an investment influencer. And so everything that she's talking about on her Instagram and stuff is like, what is the difference between a target date fund and an index fund? And should you use the target date fund? Right? And to me, that's just like the most basic. It's like, well, okay, if you're young, probably you should put all of your money into the S&P 500. If you're willing to take risk, you should put all your money into the S&P 500. But you don't want the S&P 500 to crash right when you retire and then lose all your money. So what you tend to do is you tend to move your money into bonds. As you get older, more of your portfolio will become bonds, and that way you'll be protected against that potential downside, but you don't make as much. And that's what a target date fund is it makes that move for you, right? And that's all there is to say about it, to me. And I think, I'm like, don't most people know that? But I think the reality is that most people don't. I think most people don't. And I think that her audience is more Democrat leaning. She's kind of more Democrat. So I'm sitting there like, oh, you're getting a ton of people that they literally don't know any of that stuff at all. Whereas on the Republican side, I find so many people that I think that they're probably contributing to their 401k, for instance. And like, that's really what it comes down to, is like, just match your employer contribution to your 401k and put it all in an S&P 500 index fund. There, you're done. That's all you need to know, right? Okay. But the Republicans, they probably know that stuff, but then they have so many ideas about the way that the world and finance works that are just so wrong. Like this whole thing that like everything would be better if the Federal Reserve just didn't exist. We should get rid of the Federal Reserve, and this is why it's a problem. Like, no, you guys have no clue how volatile financial markets were before the Federal Reserve got created. We have had an unprecedented. You look at the 2008 crisis, and we all think it's like super terrible, right? Okay, before the Federal Reserve existed, it was 2008 every 5 years. Okay, we just had a time period where we went almost 15 years without a severe crisis. And the only reason that we had a severe crisis was because of a global pandemic. I mean, seriously, think about that. We just came off of the longest period of prosperity and peace ever.
And it was all driven by the Federal Reserve, and all these people think it's absolutely this terrible thing. That's one thing that I see in Republicans a lot. Another one that I see in Republicans a lot is this ANCAP stuff. Ugh. I see Nassim Taleb complains about this stuff all the time, and it kind of grinds my gears too. There's these people that think that the market is just absolutely perfect and flawless, and that if we just left everything up to the markets, that everything would be fine. Right? And no. Markets are very inefficient. Like, we look at all this research, they're not very informationally efficient. There's all these problems with it, and we're trying to make all of our decisions based on what the market says. Hey, like, it's better than like the government allocating capital, but like there's real problems with it, and that means that government is constantly going to have to be coming in and kind of either help shore things up or guide the markets in certain directions and stuff. Otherwise, you're not going to be able to get the important things done. There were financial crises created before 1913 in order to convince people that the markets were unstable. The 1907 agricultural depression isn't a good example. Well, I would go earlier than that, okay? Like the 1800s, okay? The time period between when the Bank of the US was abolished by Andrew Jackson and when the Federal Reserve was created was the most volatile in economic history. And there were periods, like I think it was like the 1870s, but I would have to go back and look again. There was these periods where there was a major financial crisis every 5 years that was about on the same level as the 2008 crisis. Like, it gets super crazy. Yeah, 1812, the Bank of the U.S. was created to support the war, and then I think that Andrew Jackson abolished it in like the 30s, right? 1830s or something. And then it was like when the 1870s or so was when things started to like really get crazy. 1832. There you go. And the Federal Reserve was created in like 1906 or something, right? Oh, it was 1913. So 1913. Now, one problem that I think that people run into when trying to analyze economic history is that you got to realize that for the first 20 or 30 years of the Federal Reserve's existence, they just didn't know what the heck they were doing, right? And they made a lot of mistakes. So I don't think that you can compare like what happened in the Roaring 20s or during the Great Depression, really the same thing, right? But after the Great Depression, when the Federal Reserve kind of figured out what their proper role was and everything, then you had things were a lot better. Sure, you still had crises, but they were less frequent and they were less severe. Ever since 1913, the national. Sure. Let me tell you though, I think you're going to find these people were not noobs. Well, but they were noobs. Like, of course, they were like the smartest financial planners of that time, but it was also they were doing something that nobody had done before. Then nobody knew. We have so much science and so much experience in history to go back and look at to see what kind of financial policy works and what doesn't. They didn't have that. This whole thing, like the Great Depression, where they literally created the Great Depression by refusing to print money. Right? The current Federal Reserve would never do that. So I don't think that you can really compare the early history just because that was like the period of discovery, right? You have to look at
from John Eccles onward. The Federal Reserve before that didn't know what it was doing. They really just didn't know what they were doing. There was never a central, well, it's not true that there was never a central bank before the Fed. Certainly other countries had banks, but this whole thing of like having a governing body that sets interest rates, that was unique. But again, the way that the Federal Reserve behaves, the way that it enacts policy, changed significantly during John Eccles' career, right? So you can't compare that monetary policy before to, right? You can't say that the Federal Reserve is a terrible institution because of the policy from before, because the reason that they had the problem before wasn't because of the Federal Reserve itself, existing in and of itself, so much as it was the Federal Reserve making bad decisions. Now that we don't make those bad decisions anymore, at least that specific bad decision. Of course, there could be bad decisions in the future, but once they figured that one thing out, economic volatility decreased substantially. And that is the history. Like, again, the Federal Reserve is the greatest financial innovation of the last 200 years. That's not unethical. They literally print money, so no. If you print money, and you lie to the public about it, and there's absolutely no control whatsoever over it, then it's a scam. Okay, that's what Tether does. Okay, Tether, they create money, they claim that it's actual real dollars, and it's not. They claim that it's fully backed, and it's not, and they lie about it, right? Whereas the Federal Reserve, they have a meeting, they have a press conference after each meeting, they have a public statement. We all know exactly what they're doing. All of the people that sit on the board are chosen by the president and are confirmed by Congress. And right, we generally, we don't know when they're giving emergency loans to people, but you don't want to know that. I promise you don't actually want to know that. I'm not on the camp of money creation does not equate to inflation. I'm not. I'm on the camp that it's a complex system, and that there are inflationary and deflationary pressures, and that if you are experiencing a deflationary pressure, that you need to print money in order to create some inflation to counterbalance that so that prices remain stable. But what we did in the pandemic, and the other side that I'm on, and the bigger thing is that we put in too much stimulus. Like, stimulus after the coronavirus panic was necessary, but they put in too much. And I believe that now, more recently, we have some new research that kind of suggests how much stimulus you actually should put in, and that it's about a fifth of what they were doing. Okay, so that the way that ZN is trading here is really interesting, right? But I mean, it is what we were saying earlier. They busted the highs, tagged 126.050, and now they just had another complete sweep of the range. You know what? I forgot about the news. We were talking so much. So was that initial move because of the news? I didn't have financial juice going. 5-year inflation 3.1, 1-year inflation 5. So those were all in line, and the consumer sentiment was a little worse than expected. So maybe the move up was because of risk off. But the S&P 500 didn't really move. So I'm going to say that probably this behavior in the Treasury is really could be more explained by just internals, people's positionings and stuff. The Federal Reserve is not a reserve. It's neither federal nor a reserve. How is it not unethical? What makes it unethical? What about it makes it unethical? So I correct me if I'm wrong. It sounds to me like you're taking the position that printing money is unethical. That if any organization prints money, that's unethical. Which kind of doesn't make much sense. It's clearly that can't be your position, because then otherwise we just wouldn't have money, right? Unless your position is that the only ethical form of money is gold bars. Which I don't think is what you're trying to say. Okay, so it's true that the banks own the money, but again, all of the actions of the Federal Reserve are enacted by a body of people selected by the president and confirmed by our representatives in Congress. Why is that unethical? That's the question you got to ask yourself. What makes that unethical? So if Bank of America, they can't necessarily print money, right? They can print money within the bounds of what the Federal Reserve sets. They can create loans within the bounds that the Federal Reserve has set, which is like what they're based on what their assets are, right? They set a ratio that says if you own this much money, you can loan out this much of it, right? And then that creates money. Okay. What makes that unethical? So you're starting with an assumption that's not proven. Sure, but if it's the law that the Federal Reserve can create money, what makes it unethical? Well, the Federal Reserve Board makes those policies, right?
Block cell.
They had a big order there at 29. Somebody puking hard, I think. How much? There's some really decent delta on that. Hold on a second. That was like, when did that start? It was maybe less than 30 minutes ago. I'm just going to come back in my news feed here a second. Okay, so I see one thing about maybe war in Ukraine starts before the end of the Olympics. Consumer sentiment decade low. It's kind of interesting that the S&P 500 hasn't really reacted that strongly to the consumer sentiment number today. Gold moving up. That's a good thing. I don't really see. I don't know if it's news driven. Okay. There must be someone who is willing to take the loans. Bank of America has debts. It would be unethical for them to print money to pay their debts. No. Listen, that's not what we're saying, right? We're saying that when you have what would make that would be if Bank of America printed money in that situation, it would be unethical. Why would it be unethical? Right? Part where they don't take any responsibilities when their money creation equates to less than the value of the money. If Bank of America had debts and they just started printing money to pay those debts, It would be unethical, yes. But why? See, what you're doing is you're making an underlying assumption that something is unethical or not without actually answering why that's unethical. So, for instance, if I was president of the Federal Reserve and I enacted a monetary policy that was keep interest rates low because I own a lot of Google and Apple and I make more money because interest rates are low, and I'm doing it specifically so that I can make more money in Google and Apple at the expense of the pocketbooks of all the regular people in America that have to, pay. Hold on. And everybody else is experiencing inflation and their pocketbooks are being pressured. Also, that I can make more money from Google and Apple. That would be unethical, right? But if I am keeping interest rates at the same time, if we had a financial crisis and I kept interest rates high because I owned a lot of banks, and well, I do own banks. I own most of my portfolio is bank, right? And lower interest rates and smaller spreads means less profit for me and my bank, and I keep interest rates high, that would also be unethical, right? So what makes it unethical? What makes it unethical is holding a monetary policy that is primarily for my own benefit and harms everybody else, right? But if I come in and I keep interest rates low because I'm concerned that the Delta variant of the coronavirus is going to harm the economy, and I'm concerned about a deflationary threat. And I think, well, we can hold off on raising interest rates for a little while and let this see how this Delta variant goes over. And then it ends up that, the Delta variant wasn't very big, and I probably could have raised interest rates sooner, and now I'm behind the curve. Did I do something unethical? No, I just made a mistake, and a quite understandable mistake. And frankly, maybe I was just making a decision based on risk reward, and I determined that the risk to the economy from the Delta variant was more serious than the risk to the economy from inflation later on, which is what I think the Federal Reserve did. So is there something unethical about that? No. So what makes it unethical or not unethical? It's what the policy is intended to do. If the policy is intended to just make me profits, then that's one thing. But that's not how the Federal Reserve makes their decisions, is it? The way that they make their decisions is price stability and maximum employment. And as much as the Federal Reserve is acting to maintain monetary policy to achieve those two goals, what they are doing is to the benefit of everybody and is ethical. So you see, the mere act of printing money isn't necessarily unethical, right? Printing money when you're not authorized to do so, and you don't have a governing body that and governing policies to determine when printing money is appropriate and when it is not, which is what Tether does. They basically just print money based on whether they want the price of Bitcoin to go up that month or not. That's unethical. Want your indicators. So you can download them from speculatorseth.com, and then you can try them for free for 2 weeks. And then after that, you have to buy the license. Or if you still want to do the month thing, we can work that out too. But you just email me. Think I'll get 315s in. Well, it looks like, oh, you want to go short 315? You might. It looks awfully close. The mafia runs things. No, they're not. Not okay. Like the charter has they have a charter, and there's like laws. Like Congress passed a law to create the Federal Reserve. Okay, that's really different from just somebody all of a sudden deciding one day, oh, I'm gonna print my own currency. I know that's an activity that requires banking and all of these regulations, but because it's cryptocurrency and the regulators are behind the curve, I'm just gonna do it. Okay, it's just like, come on. Is there a law authorizing the mafia? If it's lawful, so if it's lawful, it's not necessarily ethical, but if it's unlawful, then we definitely know that it is unethical, right? But then what you're really asking is the Federal Reserve Act an ethical law? And my contention would be, what's unethical about it? No, not at all. That meaning no, there's nothing unethical about the Federal Reserve Act. Okay. Well, now, has the Federal Reserve made mistakes? Certainly it has. Has the Federal Reserve held monetary policy to benefit some, their rich buddies at the expense of everybody else? Maybe. I can't read minds, so I can't say if that's why they did it or not, but yeah, if it's unlawful, it's also ethical, but if it's lawful, it's not necessarily ethical. So all of the examples that we have of money printing that are unethical that we can cite are all examples where they're doing something unlawful to begin with, right? Okay. So if we made a law, you guys are avoiding answering the actual question, the thing that the heart of the argument. If we make a law where Seth pays 70% of his trading swings, if we made a law that everybody had to give Seth $10 every year, would that law be ethical or unethical? I think that you would all say that that's an unethical law. Why is it unethical? Sure, I know of the Rothschilds, but you're that goes into a mind reading fallacy, right? All of the Federal Reserve behavior that I have seen during my time watching markets can be sufficiently explained through the Federal Reserve following its trying to achieve its policy objectives and sometimes making mistakes. And they have really good justifications for why they made the decisions that they did. Yeah, it is getting near to that time. See, there's this question is like, why would it be unlawful to make that law? Unethical to make that law? And why would the Federal Reserve Act be unethical? Right? So I can say if we made a law where everybody had to pay me money, well, if it's just to make Seth rich, then that's certainly not ethical because again, I'm doing something to benefit myself at the expense of everybody else, right? But that's not the purpose behind the Federal Reserve Act. The purpose behind the Federal Reserve Act is to maintain financial stability. That's something that benefits everybody. There's no taking responsibilities for their behaviors. They don't act, well, they do act in an ethical way. They do. They make decisions to achieve their policy objectives, and they make the best decisions that they can given the circumstances. And yes, they will make mistakes. When things go bad, I don't think that it's the Federal Reserve that is blaming corporations for price increases. It's in fact, I don't even see Democrat politicians doing that. It's just stupid people on TikTok. But when things go bad, I think that the Federal Reserve takes the blame for it, but you can't expect the institution. It's a discretionary trading. It's an institution that is basically discretionarily trading the money supply and interest rates to try and maintain maximum stability. You're going to make mistakes in some instances, right? It's not always going to be perfect, but what we do know is that things have been more stable with the Federal Reserve than they were without it. So that means that overall, the Federal Reserve is achieving its main goal, which is to decrease financial instability. Therefore, it is an ethical institution, and in fact, I say that the financial system that we have today has created more wealth and done more good in the world than any other financial system. That's not true. Markets have been more unstable ever since 1913. That is not true. That is so utterly false. I have to go back to the history, okay? You take the Panic of 1907 and the Roaring 20s and then the Great Depression, and like that's all awful, right? And then you add on top of that all of the other recessions that we've had, the 70s, and that was inflation that wasn't really caused by the Federal Reserve or anything. But then you add the 1987 crisis, and you add the dot-com bubble, and you add the 2008 crisis, right? Those are all of the crises that have happened during the Federal Reserve. It pales in comparison to the financial volatility that we saw in the 1800s before the Federal Reserve was created. It was literally like every 5 years the economy completely collapsed in the mid 1800s. It was so ridiculously more unstable. It's like mind-blowing. Like look, I'm like going over here, but I'm gonna do this. Like list of financial crises. List of economic crises, right? Okay. And then we come to the 19th century, okay? Right? Like there was a long depression from 1873 to 1896. There was the Panic of 1873. There was the Panic of 1884. There was the Panic of 1890. There was the Panic of 1893. Okay, like think about that. In that whole time span, that's like equal to the time span of my life. And in my life, we've seen three things, really, like financial crises per se, right? And here you got like 5, 6. That's actually a bigger, I don't know. I have to go back and compare it. But like, dude, just look at it in this 100 years. Look, and just in that 100 years, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. 16 severe financial, and you got to realize that these were like real panics. These were like equal to 2008. Anyways, I gotta go. To say that the Federal Reserve is unethical is just wrong. It just doesn't match up with the facts. I gotta get going. See you guys next.